caused Japan to clear out its U.S. debt. Did you know? It costs the Federal Reserve only 20 cents to print $100 denomination, leaving $99.80. Experts often say that because of the hegemony of the dollar, these become the minting tax of each country. For every piece of green paper printed by the United States, the world has to pay for the U.S. government with $99.8 of goods. However, such a situation may no longer exist in the future. S&P Global Ratings said on November 9 that the Bank of Japan's policy could be the most critical factor in determining the country's credit rating. This means that Japan's sovereign credit rating may face its first adjustment since 2015, and this adjustment is likely to be a decline. This is another important signal that Japan's economy is in trouble again, following the yen's unusually weak performance so far this year, showing a 32-year low level against the dollar and the Japanese debt being criticized as zombie debt. And another new change in the matter is that although Bank of Japan Governor Haruhiko Kuroda continued to emphasize the need to maintain Japan's easing policy on November 10, but in recent months, with the rising cost of raw materials to push Japanese inflation above the 2% target, Kuroda has begun to comment more frequently on the possibility of future exit from ultra-low interest rates. Regarding Japan's long history of negative interest rates, he said, "It is too early to work out the details of an exit strategy. But a major factor in the debate will be the rate of increase in the Bank of Japan's short-term policy rate, currently set at -0.1%. Analysts believe that this is also a hint that Japan is issuing a normalization of its monetary strategy and may be turning to the end of 10 years of quantitative easing. And another new twist to things is that while BOJ Governor Haruhiko Kuroda continued to stress the need for Japan to maintain easing on November 10, Kuroda has begun to comment more frequently in recent months on the possibility of exiting ultra-low interest rates in the future as rising raw material costs push Japanese inflation above the 2% target. Regarding Japan's long history of negative interest rates, he said, "It is too early to work out the details of an exit strategy. But a major factor in the debate will be the rate of increase in the Bank of Japan's short-term policy rate, currently set at -0.1%. Analysts believe that this is also a hint that Japan is issuing a normalization of its monetary strategy and may be turning to end 10 years of quantitative easing. However, in response, Kim In-tan, senior credit analyst at S&P's Sovereign Ratings Division, said the risk is now quite high whether the Bank of Japan's strategy changes or not. This could be an important factor in the rating change. In other words, the Bank of Japan seems to be mending its ways. It is worth noting that so far this year, in the process of the sharp weakening of the yen, the Bank of Japan has continued to increase its bond purchases, even going so far as to make the entire Japanese bond yield curve completely distorted. While international buyers of Japanese government bonds have not been buying, the global liquidity of Japanese government bonds continues to be in trouble. Jim O'Neill, former Goldman Sachs economist and chairman of the investment firm Northern Gritstone, has said that, given the scale and history of the program, the low level of JGB yields and the fragile performance of the yen, the Bank of Japan will pose a serious shock to the Japanese economy at a certain stage if it abandons its current strategy. At the same time, Japan's foreign exchange reserves also look unbearable at this time. Although publicly available data show that Japan has foreign exchange reserves of up to $1.2 trillion, but, of this, only about $130 billion is stored in the form of savings in its Bank for International Settlements account, and the rest of about $1.1 trillion is held in the form of U.S. Treasuries. This results in Japan's foreign exchange reserves being hit very significantly by fluctuations in U.S. Treasuries. In particular, since this year, U.S. Treasury yields have continued to rise and the real price of U.S. bonds has weakened, with U.S. bond yields inversely proportional to prices. For example, the 10-year U.S. Treasury yield has risen about 3% from the year-to-date to a level of about 4.15%, which has led to a serious shrinkage of Japan's foreign exchange reserves. To add insult to injury, data show that Japan's public debt is estimated to be about $12.2 trillion, or 266% of GDP, including long and short-term government bonds, as well as various local public debts in Japan, which is the highest of all developed countries. In terms of debt to GDP ratio, the world's largest debt-burdened country is Japan. As we know, the world's largest debtor is the United States, which has a federal debt size of $31.2 trillion, or about 120% of its GDP, and comparing Japan's debt to GDP ratio, we can see that Japan's debt burden is particularly heavy. Meanwhile, the size of Japan's total debt mentioned above is equivalent to about 1,000% of its $1.2 trillion in foreign exchange reserves. This unveils the hidden truth about Japan's economy over the past half-century or so, that its rapid development over the past some years has been the result of a deep black hole in the US dollar. Coupled with the fact that Japan has been mired in a trade deficit for a long time in recent years, it explains why the value of the yen has been deteriorating. In addition, in the era of the Federal Reserve before the significant opening of QE money printing machine, the Bank of Japan also followed several years of super easy stimulus, which led to the yen assets bubble is very serious. Especially since 2012, in the Abenomics strategy, the yen accelerated weakening. Therefore, when the Federal Reserve has opened an epic 6 interest rate hikes this year, the Bank of Japan and the Japanese Ministry of Finance, despite all the efforts, but the yen and Japanese bonds are still vulnerable. In other words, Japan does not have a wide and powerful foreign exchange reserve moat to protect itself from the high debt. It keeps losing its ability to withstand the risk of a dollar rate hike. In other words, the Fed shears the wool of the Japanese economy, and Japan seems unable to cope. Despite the Fed's claim to be raising interest rates in the name of curbing U.S. inflation, it has failed to help the currency and finances of America's economic ally. Instead, the U.S. has literally harvested Japan's carry. In the latest turn of events, the latest data released by the Bureau of Labor Statistics on November 10 showed that the U.S. Consumer Price Index rose 7.7% year-on-year in October, slightly below market expectations and 8.2% previously. The U.S. core CPI rose 6.3% year-over-year in October, compared with 6.6% previously. Although the U.S. CPI fell slightly from its previous level of more than 8% for 7 consecutive months, it is still at a relatively high level over a 40-year period and is still far from the Federal Reserve's target of 2%. Immediately following, the latest forecast from Chicagoland's FedWatch tool puts the expectation of a 50 basis point rate hike at 80.6% for the Fed's December rate meeting. This suggests that while Fed governors have recently signaled a turnaround that they may hold off on rate hikes next year, there is at least one more significant rate hike this year. This is not a good indicator for the yen, which has not shown any obvious signs of rebounding. The Fed continues to reap the rewards of the yen. Therefore, from a debt and currency perspective, Japan is very passive due to its previous dependence on the dollar. There is a view that the Japanese economy may change from rich to poor and may lose the label of developed country. Analysis by the U.S. financial website Zero Hedge suggests that Japan has the potential to sell off up to $1 trillion in U.S. treasuries, which means that Japan may empty its U.S. debt. And once that happens, Japan, which has a 90% share of U.S. debt in its foreign exchange reserves, may become passive in the process of participating in global trade and economy. However, there are signs that the process of Japan's de-dollarization is also speeding up. According to a report by the Bank for International Settlements, the Bank of Japan has officially launched, together with the Bank of England, the European Central Bank, the Bank of Canada, and the Swiss Central Bank, a cryptocurrency group among developed countries that is attempting to de-dollarize. This form of currency may be used for trade and commerce between Japan, the United Kingdom, as well as Eurozone countries such as Germany, France, Italy, Canada, and Switzerland, a neutral country, and sources indicate that this cryptocurrency may also be used for future purchases of dollar-restricted commodities such as Iranian oil by Japan and other countries. Obviously, whether it's de-debt or de-dollarization, this time, Japan is playing the role of an initiator among developed countries. And since Japan is the largest holder of U.S. treasuries, the above phenomenon is not good news for U.S. debt as well as for the dollar. This is more like the financial Pearl Harbor incident initiated by Japan, and thus, the decline of the dollar reserve status is inevitable. And U.S. Treasury Secretary Yellen said that it is not clear that Japan's foreign exchange intervention has not received notification from Japan, which had previously notified the U.S. Treasury on foreign exchange intervention. That is to say, Japan is in the monetary and debt level and the U.S. economy appeared torn phenomenon. The U.S. Treasury Department has been unable to know the real monetary dynamics of Japan.